Today's question is how does the 10-year Treasury bond yield affect the mortgage market and interest rates? Very good question. And that is the yield on the 10-year Treasury, which is a T-bill, a government bond. The yield on it, when it goes up, interest rates go up. When the yield goes down, interest rates for mortgages go down. As you can see here, for this trend, each one of these marks is a day in the market, and the trend's been going up here for the last number of months. It's been reaching up. So what do? The Fed is trying to control that because they don't want real estate to become unaffordable. So what they've done recently is they printed money and then they bought the 10-year Treasury. When you buy it, it increases the price and the yield decreases because the yield is fixed. Higher the price, the lower the yield would be. So that's one way they're doing to artificially try to keep rates down a little bit. Earlier in the month, Japanese 10-year yield had become too high, and the Japanese, who are big bondholders in the United States debt of the 10-year Treasury, they were going to sell their 10-year Treasuries in order to pay down their own, do the same thing in their own market. But the United States didn't want them to sell the 10-year Treasury because if you sold it, that would make the bond yield in our market go up even higher. So what the United States did is they went over and they sold the euros that we had. They sold that, used that fund to buy the Japanese yen, which lowered their yield, which affected our yield as well. These are short-term fixes, and they haven't really done a lot, but this is what's been going on recently. As you can see, rates have gotten a little bit better. Hopefully that will have some staying power in the future. Fed is spoke to speak later this week. I believe it's at Jackson Hole. It'll be mentioned a little bit, and then on September 15th, they'll be speaking again. Do you think interest rates will go up or down in the future? Let me know in the comments. Talk to you later.